December 2025. The macro winter deepens, but the real uncertainty lies in implied volatility. The macro environment is in deep winter. Yet what's harder to forecast than any climate model is the current level of implied volatility, the market's expectation of future price swings. At this cyclical juncture, I don't care about your profit and loss. What I'm watching is your emotional indicator. Are you gripped by FOMO, fear of missing out, watching certain asset classes surge and fearing you'll be left behind on the wealth mobility train? Or are you clinging to cash, paralyzed by risk aversion, terrified that one wrong move could lead to permanent capital loss? That anxiety is telling. It proves you're still engaged. Your sensitivity to the market hasn't dulled. This emotional divergence is a leading signal of structural market cleansing. Looking ahead to the next fiscal year, global wealth hasn't vanished. It's undergoing a brutal liquidity redistribution. Capital, obeying the laws of physics, is flowing irreversibly from impulsive, undisciplined retail investors to rational, macro-aware institutional capital. This memo isn't designed to inflate sentiment or sell 100x alpha fantasies. That's not investing, that's tail risk gambling. Instead, this is a 2026 asset allocation and hedging guide tailored for retail investors, mass affluent individuals, and emerging high net worth clients. Whether your AUM, assets under management, is $500 or $5 million, as the 2026 fiscal year begins, you must establish a risk-aligned allocation logic. Because the rules of the game have reset. The end of the risk-free era. Looking back over the past 24 months, it was a golden window for risk-averse investors. You didn't need to analyze balance sheets or master technical charts. Simply locking in bank CDs, certificates of deposit, or short-term bonds could deliver risk-free yields above 5%. That era of risk-free arbitrage officially ended in late 2025. The Fed's policy pivot is now confirmed, not just a US shift, but a global decline in liquidity. Bank deposit rates will exit the 3% era and may even fall below 2%. Nominal risk-free returns will no longer outpace core inflation. What does this mean? Holding cash now means negative real returns. Inflation may be slowing, but its cumulative effect persists. When risk-free rates fall below CPI, holding cash is a guaranteed real loss. So where will liquidity go? Capital abhors a vacuum. It must engage in yield hunting, flowing out of low-yield deposit accounts and into assets offering stable cash flows. This is the biggest arbitrage opportunity of the coming year, positioning ahead of the consensus in the destinations where capital will ultimately land. But beware, there's a liquidity trap. As risk-free rates bottom out, the market will be flooded with high-yield products, P2P variants, opaque wealth management structures, and non-standard assets promising 10% plus annual returns. Rule to embed in your trading system. In a low-rate environment, any asset offering 10% plus risk-free returns isn't charity, it's likely after your principal. In 2026, capital preservation is the top priority. We seek investment returns, not gambling profits. Before chasing alpha, build a defensive beta. For most investors, 30–40% of your portfolio should be in all-weather defensive assets, your volatility dampeners. Even in a market correction or recession, a solid core prevents panic selling. What are 2026's defensive assets? Avoid narrative stocks, those built on PowerPoint dreams. Invest in companies with rent-like income streams. Here, rent means consistent dividend payouts. Target firms with 10+ years of positive dividend, CAGR compound annual growth rate. This signals strong free cash flow and a management team committed to shareholder returns. 1. Consumer staples, the anti-cycle beta. No matter how GDP fluctuates, demand for personal care and basic food remains inelastic. This is the moat of essential demand. Stocks in consumer staples and food and beverage have lower volatility than tech, but strong downside protection. In turbulent times, they're your safe haven. 2. The hidden winners of the AI cycle, utilities and power. This may be 2026's biggest valuation gap. Utilities and power companies were once seen as low-growth defensive plays with stagnant valuations. But the game has changed. Grid expansion, CapEx, capital expenditure, is lagging far behind AI's energy demands, a classic supply-demand mismatch. As tech giants compete for power allocation, firms with grid infrastructure and nuclear assets now hold pricing power. AI data centers consume energy at city-scale levels. Once a utility, power is now the picks and shovels of tech infrastructure. Without power, even the fastest chips are useless. Thus, utilities with stable grids or nuclear capacity are being revalued from defensive stocks to essential growth stocks. Offense. Seeking alpha in 2020. In recent years, Nvidia's returns were spectacular, the classic infrastructure play of the gold rush, selling shovels with the highest certainty. But by 2026, hardware penetration is near saturation. Everyone has a shovel. The next phase, who's using those shovels to generate ROI? Stop focusing on pure-play AI model companies. That space is now a capital war. Look instead at application layer winners who've achieved commercialization. Is it the biotech firm using AI to cut drug development time by 50%? The logistics giant using AI to reduce fuel costs by 30%? The limited financial institution using AI to transform customer service efficiency? 2026 is AI's commercialization year. Whoever solves real pain points and drives cost savings will be the next trillion-dollar company. Also, watch firms solving AI's physical bottlenecks like energy solutions and liquid cooling tech. Bitcoin, digital gold, not a gamble. When discussing offense, crypto can't be ignored. But in 2026, reframe your view. ETF reclassification. It's no longer a high-volatility speculative bet. After market cleansing and ETF approval, Bitcoin now functions more like digital gold. Its role: macro hedge, inflation hedge, store of value. Advice: strict position sizing, no leverage. Treat it as an alternative asset. A small allocation hedges against black swans. If it rises, you capture beta. If it crashes, convol probability. It won't impact your overall portfolio liquidity. That's enough. Execution. 3 strategy frameworks by investor profile. Phase 1. Accumulation students. Early career. AUM is kleiner than 50k. Early in your career, capital. But you have the most valuable leverage, time. You have a long runway for compounding. Pain points. Small principal, chasing high odds, easily swayed by market noise. Core strategy. Passive index, dollar cost averaging, DCA, long only. Avoid technical analysis and trading. Your capital isn't large enough to absorb frequent transaction costs and opportunity costs. Allocation. 70% in tech indices, for example NASDAQ 100, QQQ. You're young with high risk tolerance. You must be exposed to tech innovation beta. Ride the stable US. TechWave, a proven growth engine. 20% in S&P 500, for example. The beta of American economic strength. A ballast to prevent panic during sector crashes. 10% in high volatility assets, Bitcoin or high-action AI startups. Treat this as venture capital. It can go to zero, but if it explodes, it accelerates your first $100K or mindset. Even if you're down 20%, do not sell. See it as a buying opportunity. For DCA investors, market dips mean discounted accumulation. Be grateful for the low-cost entry. When you're 40, you'll thank your younger self for buying dip. Phase 2. Growth middle class, family breadwinners, AUM $50, KUM $1. Profile: the backbone of society, often with mortgages and family responsibilities. Pain points: low margin for error. A big drawdown hurts quality of life, but holding cash fails to beat inflation, education, and retirement needs. Core strategy: core satellite approach, core, selective offense. Allocation: 60% in total market index, for example, boring but safe, covers thousands of companies high. The foundation of family wealth ensures you don't fall behind. 20% in thematic sector funds. For alpha, if you understand semiconductors or aging demographics, allocate here. 15% in dividend stocks or bonds provides cash flow. This liquidity acts as a safety net during job loss emergencies. 5% speculative play money, individual stocks, options, or crypto. Even if it's wiped out, it won't affect tuition or mortgage payments. Keyword: rebalancing. Don't chase others' short-term gains. Your goal is steady wealth, compounding, not a crash. Phase 3. Preservation entrepreneur, pre-retirees, A is supérieur à A. Profile. You've built wealth as an executive, business owner, or near retiree. Goal: capital safety, X tax efficiency. You don't need explosive growth, you just need to stay rich. At your scale, 5% returns exceed a young investor's 100% gain. Core strategy: diversification, anti-fragility, allocation, low volatility, dividend blue chips. You need passive income to cover high net worth living costs. Tax-exempt bonds, municipal bonds. In Western tax systems, taxes are the biggest drag. Tax-advantaged assets are essential. Alternatives. Use your access to invest in scarce assets. Core real estate, top-tier private equity, TE, requires professional access. Gold physical assets. Insurance against extreme macro shocks. 2026. The year of K-shaped divergence. The era of buy and profit beta is over. The future belongs to stock pickers, smart money, and disciplined execution. For beginners, here's the simplest action plan. 1. Log into your brokerage account. 2. Set up an automated DCA instruction. 3. Schedule a $500-$1,000 transfer on payday to buy SP 500 or NASDAQ 100. Number 4. Then uninstall the trading app. Forget the password. Do this, and you've already beaten 90% of market participants. Ignore news noise, it's distraction. Dismiss insider tips, they're traps. Only execution changes your net worth. Only time validates value. The future belongs to optimistic, disciplined, long-termists. In this wave of wealth redistribution, may you be the one catching the liquidity, not the one left exposed when the tide goes out. Wishing you success in 2026. See you at the peak of the cycle.